My name is Carolyn Shomley. I'm the Community Manager for the Professionals for Association Revenue. We're so glad you're here with us today as we talk about unrelated business income tax, an overview for associations to understand, plan, and strategize for revenue opportunities. If this is your first time joining us for a PAR workshop, thank you. We're so glad that you're with us today. PAR is a professional member organization working to help association teams grow revenue and support the business development workforce. And today we're looking forward to learning more about something that I know is impacting so many of our associations, and that is the exciting topic of UBIT. UBIT. A different pronunciation. During today's presentation, we do encourage you to chat your questions and your comments for our expert, Jeff Tenenbaum, who we'll introduce in just a moment. And we believe that the best part of these sessions really is having an audience here together that we can collaborate and engage with one another, and you can get direct access to our presenter. So thank you so much for being with us. So to begin, I'm going to go ahead and pass things over to our PAR Leadership Advisory Board Chair, Sean Soth, for more on this important topic. Hi, Sean.
Hey, Carolyn, thanks so much. UBIT or just UBIT. I appreciate you hosting us today. Hi, everyone. If this is your first PAR workshop, well, welcome. We're really excited to have Jeff on board with us, and we'll get to introducing him here in just a moment. But we hope that you will consider making an investment in your team by joining PAR as a member. We have not only workshops every single month focused on improving business development, health, and strategy, but also really, really important member working groups where we have an opportunity to share candidly what's working and isn't working in our organizations. I feel like we get so much out of that dialogue, and we wanted to build a home for safe conversations to really improve our work and our workplaces. You know, when we started PAR, Carolyn, I remember, and you probably do too, our leadership advisory board, we came up with like all these topics that were just sort of the challenges that sales teams and revenue producers were facing across the association market. And there were some usual suspects. You know, I remember like sales skills, presentation skills, but like way down at the bottom of that list under the goal and budget forecast was these four letters, UBIT, unrelated business income tax. Well, for association programs, that could include non-dues revenue opportunities or other unique programming that just falls slightly outside of the association's stated mission. And I think one of the reasons we don't talk about it is it feels risky, right, everyone? So like maybe the idea of unrelated business income tax, because it sounds risky, it maybe has a little bit of a gap in the way you're developing products or even your revenue strategy moving ahead here in 2022. That risk continues really to be misinterpreted and unexplored by our organizations, and that's what we hope to address today. It's really a first step in an effort that PAR's making to be better informed with our teams, not only on UBIT, but in a bigger picture way, the impact improved relationships between our sales teams and our finance teams will have on our association infrastructure. Sales and finance teams really have a unique path to working towards improved revenue health. You can see I've got my snazzy new tagline. I'm just trying it out today, everybody. I don't know if it's going to stick, but we thought we'd put it on there. But it really just starts with, in those relationships between sales and finance, having a good shared dialogue and understanding of the challenges and opportunities our teams face so that we can begin to address them together. And to kind of get us kicked off, we have a quick poll to ask you. This is our current poll. We're just curious, guys, and you can answer both questions at the same time here. Have UBIT concerns ever impacted your association's portfolio plans? Yes or no? And then how would you describe, this is actually our question of the month on mypar.org, how would you describe the working relationship between your finance and business development teams? And this is just a single choice. Is it great? You guys have shared goals and regular check-ins. Is it good? Maybe you guys talk once in a while, but you have a general understanding of shared goals. Is it fair? You're working to improve those relationships, or is it needing improvement, poor, little or no communication? So if you guys could go ahead and begin voting, we would appreciate it.
Looks like most of our responses have come in, so I'll share those
Okay.
results. And this is really interesting, Sean. We have quite a variety of attendees today.
Yes, and I mean, one thing I didn't ask is, are you currently representing the revenue generating side of your organization or the finance side? That would be interesting to see how these beliefs may stack up. But I would say that it looks like for the majority, no, UBIT hasn't really impacted their association's portfolio plans, but 35% still a pretty large number. And then again, when you look at how would you describe the working relationship between your finance and business development teams, I think it's wonderful and probably indicative of many of our PAR members that there are great shared goals and regular check-ins, but we do still have some folks that are working to improve or maybe need to start from the bottom up. So thank you guys for taking a moment to share that. So who do we have to help us walk through this intimidating, risk-filled topic? You know, when we sat down and discussed it a couple of months ago as something that we needed to address, I just had this like email. I think one of our lab members chatted, call Jeff. I was like, can you maybe elaborate? And then I just did a search like Jeff UBIT. And if you haven't heard Jeff speak, he has a credible expertise in this topic and many others when it comes to nonprofit and association legal considerations. He is on the line with us now. And Carolyn, why don't you go ahead and introduce him?
Thanks, Sean. Yeah, we've really enjoyed getting to know Jeff, and we're thankful he's here with us today. Jeff is one of the nation's leading nonprofit attorneys and is an accomplished author, lecturer, and commentator on nonprofit legal matters. As managing partner of the nationally recognized Washington, D.C.-based Tenenbaum Law Group, a four-attorney boutique law firm focused exclusively on the legal needs of nonprofits, Jeff counsels his clients on the broad array of legal issues affecting trade and professional associations, charities, and other nonprofits. For 19 years, he practiced law at the Venable Law Firm and chaired its nonprofit practice for most of that time. He got his start in association law while working in the American Society of Association Executives Public Policy Division while going to law school at night. Among numerous other honors and awards, he was the 2006 recipient of the American Bar Association's Outstanding Nonprofit Lawyer of the Year Award and is one of only 6 lawyers in the prestigious U.S. Legal 500's Not-for-Profit Hall of Fame. Jeff is the author of the ASAE published book, Association Tax Compliance Guide, which he says is only slightly more popular than his second and most recent and much more interesting book, Quarantine Cocktails. And I tell you, that is not just a way to get your attention to click on it and then have Jeff really talk about tax compliance. It's actually a book full of delicious cocktails straight from Jeff. So you can check those out after today's session and in advance of your next happy hour. Jeff currently serves as chair of the American Bar Association's Trade and Professional Associations Subcommittee and on ASAE Legal Advisory Council and Public Policy Committee. So that intro speaks for itself, but now Jeff has a lot to fill us in, so I'll pass things over to him. Jeff, thanks so much for joining us, and we look forward to your presentation today.
Thanks, Carolyn. Thanks, Sean. Glad to be here today. I love that little spin you put on the tying the tax and the cocktails. I like that. It was good. I might have to use that in the future. Welcome, everyone. We have about 50 minutes here to cover a lot of ground that I wrote an entire book on. As you heard, ground that I've given full day training sessions, half day training sessions. We have 50 minutes to cover a lot, so we're only going to be able to hit it at a high level. But I think for purposes of what you guys need to know, this is not a group of attorneys providing advice and counsel to clients on UBIT compliance issues. This is what do you need to know as the finance folks, as the sales folks, as the executive director, the deputy executive director, the whatever other positions you may be in. What I found in 26 years of doing this is that, and it doesn't matter whether small or larger organization, every organization, every association, every nonprofit generally needs revenues. And a lot of revenues come from corporations, from businesses, whether we call them corporate partners, corporate sponsors, advertisers, exhibitors, affinity partners, whatever the term or multiple terms may be. These are typically corporations that are giving you money typically for some sort of marketing benefit. And this is not the only instance where unrelated business income comes up, but it's the one that I probably see the most. You have these corporate relationships, often multifaceted. The corporations want to have a relationship with you because it's good for their business, right? They're using it for marketing and business development purposes to get access to the regular members of the association to sell their products and services. The fact that you have a for-profit company that is paying your nonprofit tax-exempt organization money in order for those marketing and business development purposes, that's what at the core gives rise to potential unrelated business income. And I'm going to talk about what all this means in a second, but I wanted to kind of set the stage for that, because that at its core is where this is most relevant. And as Sean alluded to, if the folks who are doing the selling and marketing of your corporate opportunities, sponsorships, advertising, exhibit sales, everything else, if they understand these things, and in my experience, there's often a big delta between the legal and finance folks who generally have a decent handle on these things. Everyone can always have a better handle. And the folks who are actually doing the selling to bring in the revenue, who often don't. When there is a disconnect, a delta there, and that lack of information, what often happens is it leads to sales opportunities where the corporation being sold is hearing one thing from the sales folks. Then when they come and they see your, corporate sponsorship agreement template or your affinity, endorsement template, or your whatever else might be the case, often multifaceted agreements. And it has a very different construct where your finance or legal folks are pushing back and saying, well, we don't want you to offer these particular benefits to the corporation, because if so, that's going to create more taxable income for us. And we want to keep our taxable income to a minimum. That's where the disconnect causes problems. It frays relationships with the corporations. I've seen it happen time and time again, small, medium, large associations and other nonprofits. Whereas a little basic training and understanding, and I've done plenty of this sort of training myself as outside counsel for folks who work in sales and marketing departments of associations, it can really go a long way. Just having that basic understanding to be able to explain that the corporations don't want to understand the ins and outs of UBIT, nor do they have to. But if there's a basic understanding of some of these core principles, it makes for a much healthier, better relationship. You're going to end up generating more revenues, more tax-free revenues, and it's going to benefit the organization and benefit the relationship with your corporate partners. So to me, at the high level, that's why all of this matters, and that's why you should try to get a good handle on this. So I'm going to delve into some of the basics here, so to give you kind of a core understanding of the underlying principles here. So first off, so many people don't understand, so many even lawyers don't understand the difference between a nonprofit and a tax-exempt organization. They're not the same thing. Misnomers are rampant in this area. One thing is often called or presumed to be another, but they're two different things. Nonprofit status is the status that an organization gets when it incorporates as a nonprofit corporation. So in the US, all corporations are either nonprofit or for-profit. It's generally one type of nonprofit corporation in each state. In DC, for-profits are multiple types of corporations. What's the difference? A nonprofit has no owners, where a for-profit has owners. Now, there are lots of other restrictions that go along with and come via the state nonprofit corporation statute that exists in each state, limitations, prohibitions, restrictions, and the like. But the core difference is nonprofits have no profits. Thankfully, and relevant for this discussion, the term nonprofit is a real misnomer, because it has nothing to do with an inability to make profit. In fact, the most successful nonprofits make a lot of profit. It's just that the profits don't accrue to the owners like they do in a for-profit company. They get reinvested back in the organization and have to be used in furtherance of the organization's mission and purposes. But nonprofit status is strictly a function of state corporate law. It has nothing to do with tax exemption. So if you formed a nonprofit corporation and you did nothing else, you would be what I call a taxable nonprofit corporation. You would pay federal and state corporate income tax on your net income because you're just a nonprofit corporation. That being said, most nonprofits in the US take that next step of going to the IRS and applying for recognition of their tax exempt status with the IRS under one of about 30 different categories. The most common in the association world being 501c6 and 501c3. These are different categories of federal tax exemption. I'll talk about them in a minute. If you qualify as a tax exempt organization, once the IRS recognizes your tax exempt status, and it's generally recognized back to the date of incorporation, then you will be exempt on paying federal or state corporate income tax on your net income. So that's the difference between nonprofit and tax exempt status. Caroline, if you could go to the next slide. So what does tax exempt status mean for associations? So like I said, about 2/3 of all associations in the country based on ASAE surveys are 501c6 organizations. They're exempt under 501c6. The other third are exempt under 501c3. There's a lot of commonality between the two categories. In both cases, income that is earned from activities that is in substantial furtherance of the organization's mission and purposes is going to be exempt from federal and state corporate income tax. So for C6 organizations, the principal mission and purpose is to further and advance and promote the industry or profession that's represented by the association. So monies that come from things like membership dues and conference registration fees and publication sales and certification and accreditation fees and other things like that. These are all mission related because they further promote, advance the industry or profession, and they're all going to be tax exempt. For a 501c3 organization, a C3 has to principally benefit the general public more than, say, a private industry or profession. There's all different categories of C3s, from philanthropic organizations to educational organizations like colleges and universities to religious organizations, certain healthcare institutions, many other categories of 501c3s. There, it has to principally have a public purpose and mission. But that same exemption from federal and state corporate income tax and your net income exists. One of the notable differences is that for C6s, contributions are not tax deductible as charitable contributions, whereas for C3s, they are, so long as it's a true contribution with donative intent. But for C6s, most payments to C6s tend to be tax deductible as business expense to those paying the amounts. In both cases, there's a prohibition on private inurement, meaning you cannot pay more than reasonable compensation to insiders. 501c3s are limited in how much lobbying they can do, whereas C6s are not limited in their lobbying. C3s cannot engage in any political campaign activity. C6s can spend up to half of their activities on political campaign activities. I'm not going to get into all of that. But what is important here is that for both C3s and C6s, the rules governing unrelated business income are exactly the same. Next slide, please, Carol. So how did we get here? What is this unrelated business income tax? What does it mean? Well, it's an interesting story. And I remember first hearing about this, or hearing other people who are like my mentors speaking about this and speaking presentations back when I was going to law school. But it all started, believe it or not, with a pasta company that was formed and owned or actually purchased by New York University Law School. 501c3 organization. New York University Law School in New York purchased the C.F. Muller company, pasta manufacturing company. And the manufacturing sale of pasta obviously had nothing to do with the mission and purpose of the law school. But what they did is they dedicated all of the profits from the sales of that pasta to the law school and was used solely in furtherance of its tax exempt purposes. The case got challenged by the IRS. It went to the federal district court, which upheld the law school's treatment of the profits as tax-free income. Went on appeal, Third Circuit Court of Appeals. The U.S. Tax Court, where it started, not federal district court. U.S. Tax Court found that the income should be taxable. The Third Circuit Court of Appeals reversed the tax court decision, and what they relied on, what was then called the use of funds test. So back then, the standard was, as long as the funds that were raised, regardless of the underlying activity that generated the funds, so long as it was used in furtherance of the tax exempt mission and purpose, then the use of funds test would say that could be tax-free income and would not pose any threat to the tax exempt status of the organization. Well, there was a lot of outrage after that decision by kind of the business community saying, think of other pasta manufacturing companies to say, look, New York University Law School has an unfair competitive advantage. They're essentially getting federal tax subsidies to run their pasta company, even though they might be using the profits in furtherance of the law school. That's just not fair. It's competitively unfair. Congress agreed, And so being concerned about unfair competition against taxable entities, they created in 1950 the unrelated business income tax and wrote it into the tax code. Provisions in the tax code which have remained ever since. And while they've been tweaked over the years, they're largely unchanged. And what Congress did is they eliminated the use of funds test. And starting on January 1st, 1951, they put in the current construct for UBIT, which with very few exceptions has remained unchanged to this day. Next slide, please. Okay, so unrelated business income tax, what is it? So the statute, Congress imposed a three-part test. And this is important. All three prongs of this test have to be satisfied for UBI, that's unrelated business income. So I'm distinguishing UBI, which is the income, from UBIT, which is the tax. All three prongs have to be satisfied for UBI to exist. So the income has to come from a trade or business, which basically means you're carrying on the activity with a profit motive. You're trying to make money off it. Second, it's regularly carried on. And third, that the activity is not substantially related to furthering the organization's tax-exempt purposes. And if you look there, furthering the organization's tax-exempt purposes, every organization's tax-exempt purposes are a bit different, right? And so what is in furtherance of, 501c6 organization number one's tax-exempt purposes may be completely not related to 501c6 organization number two's tax-exempt purposes. So keep that in mind. It's very much related to the specific organization. Next slide, please. Actually, just go back for a second. Sorry, I thought I had more on that. Carolyn did an excellent job of helping me, make the slides look a lot more visually appealing. As an attorney, I am absolutely horrible at that. I sent her some text, which is literally just text, and she made it a lot prettier and also slimmed it down as it needed to be. So I couldn't remember what was actually there. But let me just talk for a couple more minute or two on elaborating on this anymore. The trade or business prong, pretty easy to satisfy. The regularly carried on prong, what that means is that if you have a one-off activity, you're engaging in some business activity clearly unrelated to your mission and purpose. But if that activity only happens once and never again, that's not going to be regularly carried on. Even if it happens once and it goes on for a 10-month period, as long as it doesn't happen again, that's not going to be regularly carried on. But recurring year-over-year activities are going to be considered regularly carried on. And on that third prong, as I said, it's very much fact specific depending on the nature of the organization. So you look at an activity, is it trade or business that's regularly carried on and not substantially related? If so, if all three prongs exist, then it may be unrelated business income. But as I'm going to talk about in a few minutes, there are numerous exceptions and exclusions from the definition of unrelated business income. And that's where a lot of the planning opportunities come into play, as we're going to see. There are also some planning opportunities on this front, particularly the third prong. So for instance, there's a pretty well-known IRS ruling. Can't remember if it was a private letter ruling or a technical advice memo, but either way, it was a ruling back from a number of years ago that involved a wildlife conservation group that was selling like desk accessories, like, think of like I'm holding my mouse pad, things like that. There were no mouse pads back in the day of that particular ruling, but, I think pencil cups and other things like that. And now you would think a 501c3 wildlife conservation group selling this stuff, how in the world is that going to be substantially related to your exempt purposes? So very interesting, some smart, innovative lawyers or other folks who were helping structure this. And what they did is, again, the mouse pad example, they put like an image of, like imprinted an image of an endangered species on each one with the name of it. And then they accompanied the sale, like attached to it was like a little pamphlet, little brochure, a little piece of literature that had background on that endangered species and how it was at risk and what people could do to help protect that endangered species. It educated the public on that. And the IRS concluded that because of that, the organization was using the sale of these desk accessories as a way, office products essentially, to educate the public about their exempt purposes and therefore that turned what would be an otherwise unrelated business activity into a related one. So another, common example, a lot of people think that an association or other nonprofit that is selling, like, for instance, hats and t-shirts that have the organization's name and logo on it, that somehow that is substantially related to the organization's mission and purposes. Well, no, just like, in the example of the office supplies that are being sold with only the organization's logo on them, the IRS has concluded in many cases, in many examples, that is not substantially related to the mission and purpose. Just getting the organization's name and brand out there is not enough to turn it into a related activity. So if you yourself are in the business, your organization itself is selling, certain swag and other logo items, coffee cups, hats, t-shirts with the organization's logo on it. You should be, now not every organization does what they should do, but you should be paying unrelated business income tax on the net profits from those sales. But I will talk in a few minutes about a workaround there. That's a really good solution. Next slide, please. So just a few kind of technical items here. Unrelated business income is taxed at the flat corporate income tax rate of 21%. Prior to the, I think it was enacted in late 2017, the 2017 federal tax bill changed the corporate income tax rate from, used to be a graduated rate that went up to the high 30s to a flat 21% tax rate. And since UBIT is based on the corporate income tax rate, that actually had some real significant beneficial effects for tax-exempt organizations. And both federal tax as well as a state corporate income tax for those states that have corporate income tax. There's a $1,000 deduction that everyone gets. Net operating losses are generally permitted, but there's some limitations. Their net operating losses are where you're engaging in an activity that has, say, losses in a given year where the expenses outweigh the income. You can carry those over to the next year and apply it against your profits in the following year, just like a for-profit business can do. But a couple of years ago, there was some changes, or a few years ago, there were some changes to the tax code to cut down on that because there are a lot of abuses in this area. And so if they're recurring NOLs year after year, you're not going to be able to take advantage of those. Another change that occurred in that same tax bill a few years ago was that profits and losses are determined per activity. So you've heard me refer to net income a lot. That's, of course, comparing the gross income against the directly connected expenses that are incurred in generating that income. And just like a for-profit business, you only pay tax on the net income. But unlike for-profit businesses, which take all of their revenue and then compare it to all of their expenses, and then whatever the delta is, say whatever the revenues exceed the expenses in aggregate is what you pay corporate income tax on. Here, again, trying to cut down on some abuses and also trying to raise revenue in a federal tax bill. The law now says that profits and losses are only determined per activity. So unrelated business activity A, you calculate the revenues and expenses and you pay tax on the net income. Activity B, same thing. You can't aggregate it all together, which from a planning perspective, I'll talk in a few minutes about the concept of a for-profit taxable subsidiary that associations can form. We have had some clients that have formed taxable subsidiaries, moved their unrelated business activities down to that subsidiary, because that subsidiary is not governed by this fourth bullet point there. They're like any other for-profit taxable business. So there they can aggregate all the different unrelated business activities. And just like corporations, you have to make quarterly estimated payments at the federal and state level. Next slide, please. Okay. So actually, before I get to that, an important point that I didn't mention is that one of the hallmarks of the unrelated business income tax statute that Congress enacted was that, these are the rules, 3-pronged UBIT test, use of funds test no longer applies. You look at the underlying activity that's generating the revenue to apply the test to it and see how it applies. But whatever net income you had, you pay that federal and state corporate income tax on. But the other part of it is that you can only earn what the tax code says is insubstantial unrelated business income. If your total unrelated business income is more than insubstantial, then you will jeopardize the tax exempt status of your organization. The IRS and Congress have never specified what that term means in terms of dollar amounts, percentages, things like that. But generally speaking, and there have been some exceptions, but generally speaking, what most nonprofit tax advisors in this area, attorneys and accountants say, is that you want to be safe. You want your total gross unrelated business income to be no more than 15 to 20% of your total gross income for the year. And as long as you keep it under that, you should not be putting your tax exempt status in jeopardy. If it looks like it's going to go over that, which frankly, in your world and in PAR's world is a good problem to have, right? If you're that successful at generating unrelated business income, like I've always told clients, don't let the tax laws be the tail that wags the dog. If you can, certainly, you want to minimize paying taxes as much as you can in a lawful way. But at the same time, if you can earn $3 in unrelated business income, compared to $1 in non-taxable income, you're only paying 21% federal income tax rate. You're only paying it on net income. So you may be able to offset if you're keeping good track of your expenses and time and stuff like that to help reduce that amount. From a purely business planning financial perspective, it's a hell of a lot better to earn $3 in taxable revenue compared to $1 in tax-free revenue. So just keep that in mind. I see so many associations, they let the tax law be the tail that wags the dog. They're afraid to get into like giving sponsors additional benefits because it might create some taxable income. If it makes sense from a business perspective, do it. Be aware of it, but do it. Be smart about trying to, offset with directly connected expenses to minimize your taxable income. Keep track of everything so you don't put your exempt status at risk. You can form a taxable subsidiary down the road if you need to, but don't run away from that sort of income. And then finally, take advantage of these exclusions and exceptions to the greatest extent possible, which I'm going to talk about in a minute. But first, let's talk about income that typically is taxable as unrelated business income. The most common form by far is advertising income. This is income from marketing activities, for instance, is one example. Advertising in your periodicals is the biggest example. Your newsletters, journals, magazines. That's the most common example of advertising income. But another one, would be, I said before, if you're at the top of the hour, I said, if your association is marketing a for-profit company's products or services, that is almost never going to be substantially related to your mission and purpose. So if part of the deal you're entering into with your corporate partners is to help them promote and market their product or service to your regular members of your association, things like that, that is probably going to generate some unrelated business income. That's okay. It's kind of akin to advertising income. That's okay. But I'll talk about how you can take a bigger chunk of that relationship that you have with the corporate partner and keep that tax-free. Rental income received from debt finance property, like if you own a building that has a mortgage on it and you get rental income, that's generally going to be taxable. There's a whole special set of rules under Code Section 514 about that. And then payments from certain controlled entities, whether it's a wholly owned taxable subsidiary or a majority controlled affiliate like a 501c3 related foundation that's controlled by a 501c6 association. If you have the ability to appoint a majority of the directors or you have a majority ownership over that entity, then certain payments from the controlled affiliate to the parent are going to be taxable as unrelated business income to the extent they reduce the tax liabilities of that other entity. So if a taxable subsidiary, for instance, where you have the ability to appoint all of the directors, you have sole ownership, payments of royalties, rents, things like that to the parent association will be taxable income if the subsidiary is able to take a tax deduction for those payments. It's a weird code section called 512B13, but just be aware of that. Next slide, please. Okay. What was I getting at here? Well, let's move on to the next slide. I think what I'm really getting at is trying to basically see how you can turn what might otherwise be taxable advertising income into tax-free revenue. And there's, so by the way, and Sean or Carolyn, if you could either in the chat or later on, there's an article of mine, and I think I sent a link to you. It's on our website about unrelated business income for associations. It's a pretty new article that I put together, kind of piecing together some older things that I'd written from my tax book and whatnot, but updating it. And it's a pretty comprehensive overview of these main exceptions to unrelated business income. And it gives a lot of planning techniques. So way more than I'm going to be able to cover in this webinar, but I'd encourage you, if you can share that link, and it's on our website, tenenbaumlegal.com. We have a ton of resources there, articles, PowerPoint presentations, a ton of recorded webinars, and we're always adding new stuff there. Feel free to check that out. But take a look at that article, and what it talks about is that it focuses on 3 exceptions. So as I said earlier, you got regularly carried on trade or business that's not substantially related to the mission and purposes. Generally, that is going to generate unrelated business income. But if the activity can be structured in a way where it qualifies as under one of these exceptions, then you're not going to be taxed on that income, or at least on all of that income. The 3 main ones that come into play are royalties, corporate sponsorships, and qualified convention and trade show revenue. Royalties, meaning royalties are monies that a tax-exempt organization gets for the licensing of its intellectual property, like its name and logo or its membership list. If you license that to someone else, you let them use it, even on an exclusive basis, in exchange for a fee, even if it's calculated as a percentage of sales or whatnot. That's the classic affinity arrangement, endorsement arrangement. You know, the famous cases in the 1990s, probably the most notable involving the Sierra Club, where it had an affinity deal with one of the big banks. And the bank had the Sierra Club logo on it, and the Sierra Club gave its donor list to the bank to market the credit card to its donors and others. And it paid Sierra Club, so it was a license of its intellectual property, and the credit card company paid the Sierra Club, I don't know, whatever it was, 0.5% of all sales that were made, you know, all purchases that were made on the card, the cards that had the Sierra Club logo on it. And the IRS challenged the Sierra Club in court, and they said, no, this doesn't fall under the royalty exception because the association, I mean, the Sierra Club there, but substitute association, it's all the same, is engaging in some marketing of the credit card to its donors, its supporters. So it wasn't members, but donor supporters. And the IRS said, look, because the Sierra Club is assisting the bank in doing some marketing, this taints the royalty treatment. This can no longer be, because the royalty for the royalty exception is based on the fact that it's a passive activity by the nonprofit organization, that the nonprofit is just sitting back and let someone else use its intellectual property. It's the same basis as for why dividends and annuities and capital gains are exempt. It's another exception. We refer to them as the passive income exceptions. It's basically you're letting someone else use your money and you're getting paid for it. You're letting someone else use your IP and you're getting paid for it. And as long as you do it on a passive basis, that's what those exceptions are designed to contemplate. And this is actually written into the tax code itself. But there was, question as to if the nonprofit did engage in some marketing activities on behalf of the for-profit company, would that somehow taint the royalty treatment? And in the end, what the tax court said was no, it does not taint the entirety of the arrangement. And this is later borne out in other cases, some notable, big notable ruling involving the AARP back about 10 years after that. And what the cases and rulings have come to represent is the concept that you can have a dual relationship. You can have 2 things going on. You can have the nonprofit, the association, licensing its name and logo to a company on the one hand, and then you can have, on the other hand, the association engaging in some marketing, right? Sending out blast emails to its members, giving free booth space at its convention, free ad space in its magazines, plugging the company's benefits, products or services in different publications on its website, things like that. And what the tax court said, and the IRS in subsequent rulings said, those 2 things can coexist as long as there's a clear demarcation between the 2. Back in the early days of these rulings, we used to advise clients to have 2 separate agreements, one for the royalty component, the license of the IP, and the other for the services being provided by the association. Nowadays, most attorneys like us don't do that. We say it can be in one agreement, but you want to clearly have bifurcated sections of the agreement. That's why the documentation, the planning of this is so important. Yes, you want your sales folks to communicate it to the corporations up front. Here's why we're going to do this. It may look odd to us. In the end, you may only care that you're paying us I don't know, let's say 5% or 3% of the purchase price of the products or services that we sell, we're going to pay to you. And you may not care how we divide it up, but our lawyers say we have to divide it up in this way, so that it literally should have two different sections. Say it's a 3% of the total sales, or what the gross sales, or what the association's getting in revenues. Maybe the contract says for the royalty part, the license of our name and logo, we get 2% of the sales, and for the marketing stuff we're going to do for you, we get 1%. And that's how it needs to be divided up, and it should be based on some fair market allocation. Basically meaning the more services you provide, the greater the marketing side of the equation should do. Don't do a 99% to 1% split. That's not going to pass muster. And one piece of advice I learned from a more senior nonprofit tax lawyer years ago, in those types of situations, the best thing you can do is pay a little tax. Do a reasonable allocation between the two. Because if you do, and if you get audited, and I've been through a lot of IRS audits for clients, the IRS is almost never going to challenge that. But if you take a position, if the IRS comes in and they see you're doing a bunch of marketing, but you're not allocating any to the unrelated business side, that's going to put you in some jeopardy. So that's the royalty exception. Here, real briefly about the corporate sponsorship exception, and the article that Sean posted a link to in the chat gets into all of this in a lot more detail. The corporate sponsorship exception, it was actually written into the code later. It was one of the few changes to the unrelated business income statute that came later after 1950, came in 1995. There was a lot of litigation going on between the IRS and particularly the tax-exempt college and university world over corporate sponsorships at college bowl games. And you've all seen them, been to them, heard about them. College and universities make millions and millions of dollars off of these corporate sponsorships. And the IRS was basically taking the position that, look, this is advertising. Their name is all over the place. They have exclusive deals. Coke, Pepsi have an exclusive to sell, only their products, beer suppliers, others in the stadium. How is this not taxable unrelated business income? This is advertising. And this is before 1995. And that tax-exempt college and university world and their attorneys were saying, no, the corporations are making a contribution to us, and we are just acknowledging their contributions. Therefore, that's not a business activity. That should not be unrelated business income. But the IRS was winning some of the battles. In the end, Congress came in and settled the matter by enacting a whole separate section of the tax code that deals with corporate sponsorships. And what it basically did is it codified the model that essentially exists in the public broadcasting world, TV and radio broadcasting, where public broadcast, there it's not a question of taxable income, it's a question of what are they allowed to do in terms of acknowledging sponsors. And there's a set of rules that say that public broadcasters are allowed to acknowledge their contributors, their sponsors, but they can only say certain things in those acknowledgements. And that's basically what Congress did here. And then it's one of the few areas in nonprofit tax law where the IRS came out with very detailed regulations. They rarely do that, and I've heard this, from even before I started practicing. But they rarely come out with detailed regulations, but they're really helpful regulations with some very detailed guidance. They basically say, look, if a corporation is giving you money, and you're going to acknowledge that contribution, you can do certain things, like you can acknowledge them by giving their name. You can use their logo. You can use their established slogans. You can have a non-qualitative description of the products and services that they're providing. You can have a link to the homepage of their website. You can include contact information. You can do all those things, and it's not going to treat an acknowledgement, which is kind of the one side of the chart, if you can think of it. One side is acknowledgement, and if all you're doing is acknowledging, no taxable income. Whereas the other side, the IRS considers advertising. And so if you limit the benefits to the acknowledgement side, and by the way, you can have an exclusive sponsor in a category. So say it's, I don't know, just pick, car dealerships. This is the exclusive car dealership, or, you pick your product, it doesn't matter. Soft drink provider, beer company, whatever it is. You can have your exclusive sponsor for a period of time or whatever it is. That doesn't change the treatment as an acknowledgement, but you cannot have an exclusive provider relationship, like the example of Coke or Pepsi being the exclusive provider of soft drinks at a college stadium or something like that. And then on the other side, you have the advertising stuff, things that they say are not consistent with a mere acknowledgement. Things like price information about the company's product or services, qualitative descriptions of the products and services, endorsement type language where the association or nonprofit is endorsing the company, exclusive provider relationships, things like that. And so if you provide some of those things on the advertising side, then the way the construct works is that you're supposed to put a value on that side of it. Run the standard three-prong UBIT analysis to see if it generates unrelated business income, which it usually will. And then you're supposed to pay tax on that amount. And then whatever is left on the other side, the acknowledgement side, that can be treated as a tax-free corporate sponsorship. So that's the rules in a nutshell. They're a bit more complicated than that. But the bottom line is this becomes relevant because your sales folks need to know what benefits are we offering to our sponsors, right? Now, if it's just like on the royalty example, if it's really important for the endorsed company in the royalty example to have you do some marketing, because that marketing coming from your association is so much more valuable than if it's coming just directly from the company. You may say, and they always say that, right? They always want that. You may say, okay, that's worth it. That's okay. We're fine paying a little tax here because it's going to increase the sales so much. We're going to make more money in the end anyway. And the same thing on the corporate sponsorship side. It might make some sense to provide some of those benefits that fall on the advertising side. But a lot of times what we find is that with corporate sponsorships, the corporations are fine with a mere acknowledgement. They don't really need you to do all those other things, or even sometimes want you to, or they usually want you to, but they don't need you to. And so corporate sponsorship is a way where you can sometimes turn otherwise taxable advertising income, unrelated business income, into tax-free corporate sponsorship income. One thing to keep in mind is that the corporate sponsorship exception does not apply in two contexts. One, to periodicals. So you can't have corporate sponsorships in your periodicals, like your magazines, journals, newsletters, whether they're print or electronic. You can have them on your website, though, as long as it's not part of a periodical. And the other context where it does not apply is your convention and trade show activities, which then leads me to that one. That's kind of the third. Thank you, Caroline. That's kind of the third big exception that comes up in the association world the most, outside of like the passive income for the dividends and the interest and the annuities and things like that and capital gains. That's certainly an important one, particularly, in the days when, or at least prior to the recent days when associations are making a lot of money in the stock market. That exception is very, very important and notable, but there's really not a lot of planning techniques that are available there. It kind of is what it is. But this is the third one. This is the one that's been around. It was also added to the tax code, I think 1976, the result of a very successful lobbying activity by the association community. There, the IRS was kind of making a lot of noise about trying to tax exhibit booth sales at association trade shows, saying that, look, this is advertising. This is companies paying to get an exhibit booth, to market their products and services to the attendees of your trade show. How is this any different from an advertising in your magazine or newsletter? Like, you can make the argument whether it is or it is different. Regardless, it was settled by Congress in 1976 and it's never changed. There's a definition of what is a qualified convention and trade show activity. And there is, it talks about it in my article, what is a qualified convention and trade show? It has to look like a classic association trade show, as opposed to, there are a lot of for-profit trade shows, as many you probably know. And a lot of for-profit trade shows have a very different structure to them. Some do, some don't. But the typical association convention and trade show, in terms of how it's structured, who can attend, education being provided, things like that, as long as it fits within that common construct, then the exhibit fees paid by your exhibitors are going to be exempt from UBIT. So that's an important exemption. The article also talks about this issue. It was an issue about a year and a half ago, a COVID-related issue, where back in 2020, when all the in-person convention and trade shows were canceled, and a lot of associations pivoted to virtual conferences and virtual trade shows. Virtual trade shows, from everything I've heard, were not terribly successful. Some still ongoing, there's still some hybrid components to it. But as in-person conferences have returned, kind of the in-person trade show has returned, so it's become less of an issue. But there's a question because of about a 2004 IRS revenue ruling that basically said virtual trade shows can only be covered by this exception if they take place in conjunction with an in-person trade show. But that was before the concept of today's virtual trade show existed from a technological perspective. So it's unclear how that would apply to a standalone, for instance, virtual trade show today. And the article talks about that, but I don't think that's a huge issue. But that aside, that's kind of the third exception here. And so while the corporate sponsorship exception does not apply in the convention and trade show space, you have your own exception here that does apply. The only last thing I'll say is, and I don't want to get too much in the weeds on this, there's a concept though that you can have an otherwise exempt activity that's generating tax-free revenue, but within that you can have an activity that generates unrelated business income. And the most notable place where that comes to light is advertising income. So if you have advertising in your newsletters, journals, magazine, and then you also have advertising in your convention and trade show publications, you have a daily publication like a lot of them do, or you have, an exhibitor guide. And if you have paid advertising in there, if you have all of that, then the IRS says that that's one big connected advertising program, and that's all going to generate taxable advertising income, even though part of it comes from your convention and trade show. So you should be aware of that. Carolyn, next slide, or we might be near the end here. Yeah, so I talked a little bit before, if you are lucky enough to stumble upon some unrelated business activity that starts to really grow and grow, there's a lot of good examples out there, but one I remember that always sticks in my head, a 501c6 called the National Association of College Stores. It's like a trade association of college bookstore, college and university bookstores. They started a group purchasing program years ago where their member stores could kind of purchase different, items that went into their stores on a group basis, be able to get, leverage from group buying and discounts and things like that. But the association's operation of a group purchasing program is almost always going to be unrelated to the mission and purpose. It started to grow so much, they formed a taxable subsidiary, they put it in there, or maybe they did it from the outset, I don't know. But it grew significantly. And then they started expanding to other things beyond college and university bookstores. They expanded to group purchasing for other industries. And then they started doing publishing and other things like that. And, it got to the point last time I checked, which was a number of years ago, the annual budget of a subsidiary was like $100 million. And the annual budget of the association was like $10 million. And with a taxable subsidiary, this is important. I talked about earlier the fact that dividends are a form of tax-free income. That subsidiary can earn as much money as it wants without limitation. Of course, it's going to pay tax on the net income, but then the after-tax profits can be paid to the parent tax-exempt association in the form of dividends, all of which are tax-free to the parent on an unlimited basis. So again, if you are talented or fortunate enough to stumble upon activities like this, don't run away from them because you think they're growing. They're growing too much. Put them in a taxable subsidiary. The subsidiary, by the way, does not have to have its own staff. It doesn't have to have its own office space. It can lease all of that from the association. It has to pay for it at fair market value, like at cost or cost plus. But so it's fairly easy to operate. You just have to make sure your staff are tracking all of their time and expenses and other things carefully, because the tax exempt organization is not allowed to subsidize the taxable subsidiary in any way. But the subsidiary can certainly help to subsidize the association. Next slide, Carolyn. That's about it. So we have about 6 minutes left. If anyone has any questions, I would be happy to answer.
Well, it sounds like, you were completely unprepared for today's webcast, James. Great job. Thank you for, I think in particular, I know for me, just understanding a little bit more about the subsidiary and what that could be, what that means. We actually had a couple of questions sent prior to us starting today. And everyone, I want to share that you're in a safe place. The chats aren't shared. We don't put them out there. If you do have a question that's important from your portfolio for Jeff, you can either send it to any of us directly, and we don't have to share who that question is from. But in this
by the way, Sean, before you get to that, one thing I thought about on the subsidiary issue, because it just came to light in a call I had with a client this morning. think broadly about the use of subsidiaries. And if you want to really be creative and aggressive in your association's business activities, you can form a taxable subsidiary now even before you have activities to put in there. And you can think about ways to grow it. But I have a client, we haven't figured out, there's pros and cons of different structures, but they're essentially it's a C3 that's going to form a taxable subsidiary that is going to do a joint venture with a for-profit company. So what we'll probably do is form like a C Corp, like a wholly owned taxable subsidiary, and then that for-profit company will do a joint venture, probably a 2-member LLC with this other existing for-profit company, and they will partner up in that way. So there's no limit to the ways that you don't have to do it all on your own, right? You can partner up, you can do a joint venture like that, like through an LLC or just a partnership agreement. You can do a licensing model where you're licensing certain things that you might have to a for-profit company to do things. There's really no limit to it, but think creatively, especially if there's some connection back to your association. I generally don't see these things being successful when they go way off the rails and they go into whole unrelated activities, but utilize the role that your association plays in your industry, the reputation it has, the connections, the membership, roster, all of that. If you can capitalize on that, there's a lot of potential great ideas that can flow your way.
I'm interested in exploring it. I think your idea of being a little proactive in setting something up is a great one. My day job is in life science. And so with our association, we do a lot of working groups around specific industry topics. And to be honest, some of them probably would be very well aligned with this subsidiary idea. So thanks for giving that food for thought. It looks like we do have a couple of questions coming in, Jeff, but one that came, and I see actually before, and actually it looks to me like Bruce is sharing it here. If an association sponsorship involves educational sessions, education like articles, content in the magazine, etc., no references to the sponsor company's products, is the sponsor fee not subject to UBIT? So no product mentioned?
Yeah, I got it. It's a great question. So, and we deal with this a lot. So I talked about, royalties and sponsorships and convention and trade show, like exhibitor contract or something. And when I first learned about all these UBIT issues, it was great and easy to kind of analyze. I learned each of those different buckets and learned the rules and how they work and what you can do and can't do without generating taxable income. Because remember, it's not about what you can and can't do. It's what you can and can't do in order to avoid paying unrelated business income. You can do any of those things. You can provide any of the benefits. That's an important concept to keep in mind. But where it got complicated for me, and where it gets complicated for younger lawyers in my space, is when you have a deal that comes to you, and that's something that the salespeople negotiated, and it's multifaceted, right? It's got all sorts of things in there. You got a corporate partner relationship, for lack of a better word, and it's got an endorsement, from the association. It's got a corporate sponsorship component at events and also on the website. It's got trade show exhibit booth space. It's got advertising in the periodicals. It's got the opportunity to give educational sessions. It's got opportunities to publish articles in the magazines, both of which would not reference the company's product or service, all of those things. And so then the question comes, how do you analyze all of that? And how do you do the UBIT analysis there? And the way you need to do is you need to break it out into different buckets. And the contract that you enter into, we actually have like a good template, a template agreement that we use as a starting point. Every one of them is a little bit different, that has all those different components. And what you want to do is say, okay, endorsement, you're going to use our name and logo in exchange for royalties. That part's tax-free royalty income. We're also going to do some, marketing of your company's product or service as part of that endorsement arrangement. That's going to generate some marketing services income, which is taxable. We got the corporate sponsorship component. All the benefits fall on the acknowledgement side. That's tax-free corporate sponsorship income. We got booth space at our trade show. That constitutes tax-free convention and trade show revenue. And by the way, your finance folks need to know this because they need to book each of these things in the different categories. That's important. And it gets reflected on that Form 990 that way. And then you have the right to, deliver some purely educational sessions, at the conferences or webinars and things like that. And the right to publish certain educational articles in the magazine. Those should be related activities. if they're not, even though they might identify the author as a employee or an owner or whatever of the company, so long as it's purely educational in nature, and it's not a dressed up sales promotion for the company's products or services, those two things should be related income. So that's the way you analyze that. That's how it should be structured. And then you want to use kind of self-serving language in the contract to reflect that.
That's great advice. Thanks so much. I know I've spent many a closeout of a fiscal year working to break things out over the course of the career. And I think just having a little proactive understanding with the finance team, sales folks on how that might look would help all parties involved. Yeah. And you said you had a template available.
Yeah, that's not something we generally share.
Okay.
It's kind of proprietary. We use it as a starting point, and frankly, it only does you so much good, because those things, they really have to be tailored to each particular situation. But just knowing it needs to be constructed that way, and making sure your sales folks know that they should be talking about it. Yeah, nothing wrong with selling a multifaceted package. That's how you're going to bring in more revenues for the organization, the more touch points. And like I said, if you got to increase some of the benefits that are going to create a little more taxable income, that's fine. Don't be afraid of it. UBIT is not something you need to be afraid of. It's just something you want to be smart about and plan for.
Jeff, since we got a few folks just hanging on just with one more question, everybody, and that was, what if you don't have magazines, but you do have a conference, or maybe all your revenue in this aspect is related because they're conferences, but part of the package is like an exhibit and an ad at the conference. Like maybe you have a program guide at the conference, but you don't have a publication. Is that related?
Well, where is the ad showing up?
So you go to the conference, I've sold you a sponsorship, perhaps you get a booth and an ad in the program guide, but that program guide is only at the conference. We don't, you're not mailing it. It's not part of a publishing strategy. Yeah, it's just the guide.
Yeah, I've had this. There's another more senior tax lawyer who I've picked the brain of for a number of years, and we used to have this discussion. And it's really a bit of a theoretical one, because we're not aware of any cases or rulings, at least publicly available ones, on point. Theoretically, if the advertising only occurs at the qualifying convention or trade show, and it meets the definition of a qualifying convention or trade show, and there's no other advertising program that the association has in newsletters, periodicals, on its website, generally only at the conference, I think you'd have a pretty strong position that falls within the qualifying convention and trade show exception, because the exception is written so broadly. Basically says all revenue from these activities is going to be taxable. So there'd really be no basis for carving that out. So in that particular situation, which is unique, that's not typical for most associations, as you know, but in that particular situation, I think there's an argument that it would be tax-free. But of course, like in every other situation with tax law and other forms of law, IRS could take a different position. A lot of times, luck of the draw, what agent you get. But actually, where this comes to light more often is with your auditors of your external financial statements, because they come in every year, assuming you have an audit. They come in and they look through, and one of the things they're looking at is, do you have any uncertain tax positions, which means, are you treating something as tax-free, which really should be subject to unrelated business income tax? And if they find something and they disagree with you, then it becomes an issue. And I'm not going to get into what you have to do to deal with that, but it can make it really complicated. But that's a situation where I've been brought in. They're like, Jeff, our auditors are taking this position. Will you please talk to them and convince them that it's not an issue and that we have a strong position for taking this position? These things are not black and white. But anyway, in that particular case, that's a position that I would probably take.
Thanks for the guidance on that. Everyone, thank you for spending a few extra minutes with us, Jeff and audience members. We welcome you, hopefully, if you haven't joined PAR, we hope that you will. And I want to tell you that next week, actually, we're doing a member meetup on what our revenue producers need to plan for in Q2. So just talking about a round robin about what our revenue producing teams are dealing with in Q2. Sharing ideas and solutions. I hope you could join us next Wednesday at noon. And then Carolyn, we've got next month, we're talking about how associations can successfully deliver digital revenue. So some of the things association teams are doing to do just that, and the pathways you may need to take to get to that place. What platforms? How do you have group decision making? That type of thing. So we hope to see you same time and place in May for our session on delivering digital revenue. On behalf of PAR and our Leadership Advisory Board, thank you, Jeff, so much. Thank you as always, Carolyn, and thanks everyone for tuning in today. We look forward to seeing you again on another PAR workshop real soon. Thanks, everybody.
Thank you, guys.